What if I told you Warren Buffett, the world's fourth richest person, doesn't just pick winning stocks, he fires people every day? It might sound crazy, but it's a key part of his secret to making billions. Most people think success comes from adding more to your life, but Buffett shows us that sometimes, it's about getting rid of what's not working. Here's a shocking fact: Warren Buffett's wealth is not just from smart investments. It's from his ability to make tough choices, like selling off bad investments and even firing people who don't fit his vision. And this strategy has earned him over $100 billion. Yes, you heard that right, $100 billion. In this video, we'll dive deep into how Buffett's mindset of firing can actually lead to success. From firing distractions and ego to firing fast decisions and poor investments, you'll discover the simple yet powerful strategies that have helped him dominate the investment world. Stay tuned, because what you're about to learn could change how you think about money, success, and your future. Chapter 1. The Paradox of Success. Why firing can fuel your portfolio. One of Buffett's most underrated strategies is knowing when to fire an investment. We often hear about people holding onto stocks or businesses for too long, even when they're underperforming. Buffett, however, doesn't hesitate to sell off poor investments. He once said, "The stock market is designed to transfer money from the active to the patient." He doesn't keep bad investments around just for the sake of loyalty or hope. In fact, he has repeatedly said that investors should treat their portfolio like a business. And just as a business would fire an underperforming employee, you need to let go of investments that aren't delivering. In 2017, Buffett sold his entire stake in IBM, a company he had once touted as a great investment. He realized that the company was no longer the value he had originally seen in it. This decision might seem painful, but it was the right move. It freed up resources to invest in other opportunities that had greater potential. Buffett's philosophy on firing bad investments is clear. If you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes. This mindset helps prevent impulse buying and encourages patience, the cornerstone of value investing. Studies have shown that long-term, patient investors often outperform those who make frequent trades. According to a 2021 study by Vanguard, investors who held their stocks for 10+ years earned an average annual return of 8.5%, compared to just 3.5% for those who traded frequently. So, firing bad investments early can actually be a catalyst for a growing portfolio. Chapter 2. The Unseen Worker. How Buffett fires the noise and finds the gold. Buffett is a master at blocking out distractions. He calls it the unseen worker, the noise that tries to pull investors away from their long-term goals. When everyone else is panicking or chasing the latest trend, Buffett remains calm and focused on fundamentals. Buffett famously avoided the dot-com bubble of the late 1990s, a period when many investors were throwing money at tech stocks without understanding the true value of the companies behind them. He once said, "The stock market is a device for transferring money from the impatient to the patient." That is, while everyone else rushed into the frenzy of high-flying stocks, Buffett stuck to his principles of investing in solid, profitable companies with a long-term outlook. The noise of the market can distract even the most experienced investors, but Buffett has mastered the art of filtering it out. It's not just about knowing when to act, but also when to do nothing. A study from the CFA Institute found that the average investor's annual return between 1999 and 2019 was only 2.9%, compared to the S&P 500's average of 5.6%. The lesson here is simple. Avoid the distractions, stick to your strategy, and don't get caught up in the hype. For Buffett, the real opportunity lies in finding businesses with durable competitive advantages, companies that can thrive even when the market is noisy. He's known for investing in brands like Coca-Cola, which have remained solid over time. "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price," he once said. By avoiding the distractions of trends and fads, Buffett has consistently found gold in companies with solid foundations. Chapter 3. Fire your ego. The key to Buffett's humble investing edge. One of the most important aspects of Buffett's success isn't just his investment strategy. It's his mindset. Buffett is known for his humility, and he often emphasizes how crucial it is for investors to keep their egos in check. Ego-driven decisions can cloud your judgment and lead to poor investments. Buffett has said, "The most important quality for an investor is temperament, not intellect." This means that your ability to stay calm, make rational decisions, and avoid emotional reactions to market swings is far more important than having an IQ of 160. By firing his ego, Buffett avoids getting swept up in the emotions of the market. He knows that long-term success comes from sticking to his principles, not from trying to show off or be the smartest person in the room. For instance, when everyone was excited about the dot-com boom, Buffett stuck to what he knew best, investing in value stocks. While many others were buying tech stocks at inflated prices, Buffett refused to join the frenzy. This decision was rooted in his disciplined mindset. He didn't let his ego push him to chase the next big thing. And guess what? While many tech stocks collapsed in the early 2000s, Buffett's strategy kept paying off. This strategy is not just about making the right financial decisions, it's about how you approach investing as a whole. Studies have shown that investor behavior is the #1 factor in long-term returns. According to Morningstar, investors who make decisions based on emotions tend to buy at market highs and sell during market lows, which results in underperformance. Buffett's ability to fire his ego keeps him from making these mistakes. He knows that being patient and humble leads to more consistent, long-term gains. Don't forget to subscribe. If you're finding these strategies helpful, hit the subscribe button so you can continue learning from Buffett's genius and start applying his lessons to your own life and investments. Chapter 4. The Power of the Pause. Why Buffett Fires Fast Decisions. Warren Buffett has built his fortune not only through smart investments but also by avoiding the pitfalls of hasty decision-making. One of his most powerful strategies is the power of the pause. Rather than jumping into investments or making rash decisions, Buffett takes his time to think through each choice. This slow, deliberate approach has saved him from making costly mistakes and allowed him to focus on the best opportunities. Buffett often says, the most important thing to do if you find yourself in a hole is to stop digging. In the world of investing, this means that it's vital to avoid making impulsive decisions that could dig you into a deeper hole. By stopping, reflecting, and analyzing before making moves, Buffett's strategy helps him avoid unnecessary risk. In fact, many of his biggest wins have come from waiting for the right moment to buy. This long-term, patient approach often contrasts with the quick wins mentality of many investors, especially those in the fast-paced world of day trading. Studies show that more active traders tend to underperform the market in the long run. A 2016 study by the Financial Analysts Journal found that active traders earned only 2.6% annual returns on average, compared to 6.3% for passive investors. Buffett's focus on long-term strategies, combined with his refusal to rush, explains much of his success. Buffett also applies this principle when making major decisions about buying or selling companies. He has said, "You don't have to be a genius, you just have to be patient." The waiting game has worked in his favor for decades. For example, when Buffett first invested in Coca-Cola in the 1980s, he did so at a time when many others were skeptical of the company's future. But instead of reacting quickly to short-term market fluctuations, Buffett paused and recognized the long-term potential of the brand. His patience has led to massive profits from this single investment, proving the value of taking a step back before acting. Chapter 5. Firing the Fear. How Buffett embraces market downturns. Another major strategy that Buffett uses to grow his wealth is his approach to market downturns. While most investors panic when the market drops, Buffett sees these moments as opportunities. He's known for his calm and collected demeanor during times of market volatility, famously saying, "Be fearful when others are greedy and greedy when others are fearful." This contrarian mindset is one of the cornerstones of his investing philosophy. During the 2008 financial crisis, while many investors were selling off their stocks, Buffett was buying. He made high-profile investments in companies like Goldman Sachs and General Electric when their stock prices were at rock-bottom prices. These moves weren't based on luck. They were based on his belief that market crashes can create opportunities to buy quality assets at discounted prices. As Buffett put it, opportunities come infrequently. When it rains gold, put out the bucket, not the thimble. This strategy of buying during market downturns has proven to be incredibly profitable. According to a study by the National Bureau of Economic Research, buying stocks during market crashes and holding them for long periods has outperformed other investment strategies. For example, the S&P 500 index, which Buffett often recommends, posted an average return of 9.8% annually from 1926 to 2020. This statistic highlights that downturns, when managed wisely, can provide some of the best buying opportunities. Buffett's ability to embrace fear and make calculated decisions during market dips is a rare skill. While the average investor might panic and sell their stocks at a loss, Buffett takes advantage of these market fears to make investments that will pay off in the long term. It's a mindset that allows him to profit from situations that others would avoid. Chapter 6. Buffett's Legacy. The people he fires to build the right team. Investing isn't just about picking the right stocks or understanding the market. It's also about surrounding yourself with the right people. Buffett has built his success not only on his own knowledge but on the strength of the team he has around him. He's known for his ability to find talented managers who share his long-term vision and values. But that doesn't mean he's afraid to fire people who aren't up to the task. Buffett has always believed in hiring the best people and then giving them the freedom to do their jobs. He famously said, "The best thing I did was to choose the right people to work with." However, he's also been clear that if someone isn't a good fit for his team or the company's long-term goals, he's not afraid to make changes. This is part of his strategy for ensuring that every business under the Berkshire Hathaway umbrella has the right leadership. In his 2016 annual letter to shareholders, Buffett talked about the importance of leadership in his companies. He mentioned how, in some cases, he had to fire underperforming managers or replace people who weren't fully aligned with his values. This strategy is crucial because, at the end of the day, a strong team is one of the keys to business success. A company can't thrive if the people in charge aren't capable of executing on the company's vision. Thanks for sticking with us through this journey. Don't forget to subscribe so you can keep learning these valuable lessons from Warren Buffett. Apply these strategies to your own investments and start building wealth with confidence. See you in the next video.